I wouldn't buy to let in 2026. This is a presentation by Alan Edwards from Alpus Group. After 30 years managing property developments across the UK and internationally, I come to realise that buy-to-let is no longer the holy grail that it was previously, since the Section 24 changes to tax regulations. For example, if you were a landlord in Birmingham and you bought a property in 2020 at 1.5% mortgage rate, today refinanced at 5.8% or higher, net yield has dropped from 6% to 2.1%. After Section 24 tax, he makes £400 per year profit on a £200,000 asset. That's a 0.2% return. This is because the revenue is treated as profit by the inland revenue, and you pay tax on the whole revenue. You can't offset your costs. So the real numbers, interest rates went up from 1.5% in 2021 to 5.25% in 2026. Net yield after tax has reduced from 6% to 0.2%. That is less than a savings account. So what does this mean if you're holding buy-to-let properties right now? Your margin has actually collapsed. It means you're likely sitting on an asset that generates less return than a savings account. And the situation is only getting worse with the Renters' Rights Act and the increased regulation favouring the tenant rather than the landlord. So, summarising, Section 24 mortgage interest relief. Landlords can no longer deduct mortgage interest from rental income. Tax is now calculated on gross rent, not profit. EPC rating C requirement, £10,000 to £20,000 per property, needs to be spent on all rental properties to meet that EPC rating. Upgrade cost falls entirely on the landlord before a single tenant moves in. Renters Reform Bill, Section 21 abolished. That's no-fault evictions have been eliminated. Landlords lose the right to reclaim properties without proven legal grounds. A fundamental shift in control away from the landlord to the tenant. Licensing and compliance costs rising. HMO licensing, selective licensing schemes, and safety compliance add thousands in annual costs. Local councils expanding enforcement. The regulatory burden is only growing. New legislation is accelerating, not slowing. Each new rule encompasses margins further and increases landlord liability and exposure. If you're currently holding buy-to-let properties and want to understand whether your portfolio is still valuable, I offer a free strategy call where we analyse your numbers and explore your alternatives. And we have got some alternatives that we can discuss with you. But first, there is one more regulatory change coming in 2029 that will force thousands of landlords to sell. And after that, I'll show you the exact yield figures for the alternative. So that is why buy-to-let is broken. Now let me show you what serious investors are doing instead. This is one asset class generating 8 to 12% net yields, backed by government-funded tenancies on 15-year inflation-linked leases. It's called Specialised supported housing, and the government is effectively underwriting the returns. Long-term government-backed leases secure inflation-linked rental income underpinned by local authority contracts, not market-dependent tenants, so you're not taking the void risk. Higher yields, 8 to 12% versus buy-to-let, which is less than 3%. Specialised supported housing delivers net yields 3 to 4 times greater than traditional buy-to-let, even after costs and management fees. Social impact and growing demand. UK demand for supported housing far exceeds supply. Your investment addresses a critical national housing shortage. Reduced regulatory risk. No Section 24 tax restrictions. No EPC upgrade liability. No Section 121 concerns. Specialised supported housing operates outside traditional buy-to-let regulation. It's a hands-off, institutional-grade investment and providing great returns. It's professionally managed assets with long leases, minimal voids and government guaranteed income streams. Delivering 36 supported housing sites across the UK in just 3 years, proof that the ALPAS framework delivers real results. 36 supported housing sites delivered across the UK in 3 years. That's our target. If you want to participate in these sort of projects from an investor point of view, we can also help you to find sites. And this is with our done with you or done for you service. We can source specialised supported housing properties up to £300,000 for a done for you fee. We can then actually work with you in a joint venture, or we can allow you equity participation in a specialised supported housing site. Probably this would be starting off with a bungalow, which are often required bungalows with 4 residents sharing facilities. Buy-to-let is no longer viable. Net yields are increased by going to specialised supported housing model. You've got no void risks, you've got no Renters' Rights Act, you've got no EPC improvement ratings to deal with. If you're at all interested in investment in specialised supported housing as an alternative to buy-to-let, and this is why I don't invest in buy-to-let in 2026, book a free strategy call with me at calendly.com/AlanJE. You can call me directly on 07539141257, or from outside the UK, that's +447539141257. You can drop me an email at alan@alpasgroup.com. Don't forget to like the video, comment on it if you've got comments from your own experience, and subscribe to our channel. Cheers for now.